All right, good afternoon, everyone, and welcome to today's webinar. My name is Zach Shalafor, and I am a partner with James Moore & Company and the leader of our firm's government services team. For today's webinar, for those of you who have participated in the last few webinars of our 2020 Government CPE series, we are going to do things a little bit differently today. Pensions and OPEB are can be a very dry topic, so we're going to do our best to make it a little bit more lively, and we're going to go with a video format today with much more of a discussion element to today's session compared to the more typical presentation format that many presentations in our past webinars have been in. As with the past webinars, though, this webinar will be also a 75-minute webinar eligible for 1.5 hours of CPE credit that do qualify for ANA hours. A couple quick reminders with regard to the webinar before we get into it. First and foremost, if you do have questions as we are working through the content, we do invite you to submit those questions via the questions control panel on the GoToWebinar platform. And additionally, if you have any issues, you can submit those via the questions. There is also a chat feature on the GoToWebinar control panel that I will be monitoring. If there are questions, we'll try to potentially get some of those involved as we go through the material or at the end of the program. If there's any that we cannot get to, we'll be sure to have somebody follow up with you regarding those questions. To get CPE credit, you will be required to answer 3 polling questions throughout the session, and there will be a CPE evaluation form with a CPE request that can be completed upon the end of the presentation. We'll go through those specific details once we get there. To talk a little bit now about our presenters, you can see them on your screen now. First, we have James Halleran with us. James is a fellow partner of mine here at James Moore & Company. James, of course, participated a couple weeks ago when we did our GASB update to kick off this series, but today you get to see James and hear from him. And then one of the differences on this one is we actually have an outside guest with us, Chad Little, who is an actuary and partner with Fryman Little Actuaries. Chad is based in Brevard County, and I'm especially excited to have Chad joining us today, not just to provide the experience direct from an actuary, but on some of the mutual clients that we work with. Chad's always done a great job taking very complex matters in the actuary report and really taking those and summarizing them, explaining them in a very straightforward layman's terms that probably just about anyone could understand despite the complexity of pensions and OPEB. So James, Chad, welcome to you both.
Thank you.
Thank you, Zach.
Quick rundown of the topics that we're going to go through. So we are going to look a little bit at pensions and OPEB, probably a lot more at pensions, just the way things have gone, looking at the market, the impacts of COVID-19. Of course, as I mentioned, any questions that we have, we will be glad to take those as we go. We've got a quick summary of the topics that we're going to touch on. We're going to take a couple topics at a time, talk through those, throw some polling questions in there. And again, as you have any questions on the topics that we are discussing, general questions or otherwise, please feel free to submit those to us through that control panel on GoToWebinar. That said, our first section, section 1, we're calling it, setting the stage of what we have just to contend with as it relates to pensions and OPEB. So first, every state is different in terms of the rules that you have to follow with regard to pensions, what makes OPEB applicable in certain cases. So what we want to look at first, probably with you, Chad, is what's unique to the calculation of pension and OPEB liabilities, specifically to Florida governments from your perspective.
So the main difference is the way what we have that is unique to Florida is that funding is required. That is not the case around the rest of the country. So the basic setup is a pension board is created, and this is just in general, it's different in different places, but in general, you get 2 people that are appointed by the city, 2 people that are elected by the employees. Those 4 then get an independent 5th person to make up a 5-person board that we typically see around Florida. And what happens is the employees and the municipality agree to, these are the benefits that we want to pay our participants. And once they decide on that, they hand it over to this board, which is now independent. That board then hires professionals, actuaries, auditors, et cetera. And once they determine, so the city has handed it over and said, these are the benefits we want to pay. You as an independent board, tell us how much money we need to give you, and then you invest that money. And then you pay out the benefits and administer the plan. So in state of Florida, what's unique is once that pension board says, based on the assumptions that we've adopted, et cetera, the required contribution is X, X has to be deposited. And we don't see that around the rest of the country. It's not that common, actually, for there to be, solid pension funding laws to require that funding to be done. Now, the same is not true of OPEB because you don't have to have an actual trust in place to provide OPEB benefits. But at least on the pension side, one of the things that is unique is that we do have that requirement to make it. And then in addition to that, there are actual funding rules in place through Florida Statute Chapter 112 that provides the various requirements that are made on the actuary for determining that required contribution.
So I think as we talk about Florida and other states, I think kind of one follow-up question to that is, for me personally, I'm very much in the bubble of Florida pension plans where we've heard about plans in Florida that have issues. And some plans are well funded, some plans are not, but it's all kind of been within the context of Florida plans. From what you've seen in the industry, where kind of does Florida rank, whether it's FRS or pension plans in general, with regard to just kind of what's out there in the rest of the country from anything that you've seen or heard, in your circles?
So in general, I would say that Florida is much better off than most of the rest of the country when it comes to funding, and it is because of that requirement. So we may talk about, I think we actually have some discussion on the impacts, how GASB works as far as providing ratings and things of that nature. In Florida, because we are required to put in that regular contribution, we do not have the same issues they have around the state. And for those of you that have, some of your participants are in the Florida retirement system, FRS is one of the best funded pension plans in the country. It's always been very well funded. It goes back to a period of time. They do not have the same rule, by the way, that when the actuary says, here's how much you need to put in, this is how much you need to put in, the legislature then decides how much they're going to put in. And they typically have put in enough. But if you back up, 20 years ago, the requirement of the contribution that was going into the Florida retirement system was well above what was needed or what the minimum would be. And because of that, FRS developed this good funding position where their funded percentage has always been fairly high. And it kept them at a very nice funding level. Over time, that has deteriorated some. Most of what you see in the pension world today, most of the discussions we have, are based on the downturn in 2008. And that followed by another year of bad returns in 2009 caused most of these contributions to balloon up to make up for that difference. And FRS was no different than anybody else. But they did make the adjustments. They have been making the contributions, and they're doing an outstanding job funding that plan.
All right, and James, from an audit standpoint, when we look at the issues and intricacies unique to Florida, from the audit standpoint, how does that impact the look at the actuary's qualifications from an auditor standpoint? And it might be worth too just kind of throwing out there, what are the required steps that we have to take when we look at an actuary report as part of the audit?
Yeah, so one thing that both for our governmental clients, we always encourage them is, as part of our audit, we have to evaluate the actuary. They should be doing that as well as when they're hiring an actuary. One example for OPEB is for them to really understand there's a Florida statute that it says, if you have basically a defined benefit type pension plan, you're going to be subject to OPEB in the state of Florida. because you're required to provide health insurance at the same rate of your current employees to any retirees. So with Florida, with that state statute, years ago when OPEB was first issued, there was a push to try to get that out. And then there was a little property tax issue going on then. So we kind of lost momentum and didn't get that statute changed. And that's what kind of killed it for a lot of small governments, that OPEB applied across the board. So that's just one example of kind of when you're evaluating your actuary, it's important for them to understand stuff like that, as well on the pension side, for them to be familiar with firefighter pensions and police pensions, that there's state insurance premium taxes that go into those plans. Fire has two different types of contributions. There's a regular state insurance premium, and then there's a supplemental as well. That I don't think, it's been a couple of years, I think, since the supplementals kicked in, but hopefully again they'll get the supplemental. So those are some of the things we look at. And then from a pure auditing standpoint, what we're required to do for the pension plans is, we have to look at the census data, the same census data you send to your actuary. As an auditor, we're required to look at that census data, compare it to prior years, see what those major changes are in that actuarial data. We also have a requirement to test new hires to understand, the risk is that someone should be in the pension plan and is not. That's one risk that we have from an audit standpoint. Is everyone who's supposed to be in the plan, basically completeness, is everyone in the plan? Then, of course, you always have the other risk with census data. Is it accurate? For completeness, does it include the whole population, not just the new employees as well? So all those things kind of factor in, and then you're also looking at, well, what assumptions did that actuary use? So we have sometimes a pretty wide range we see on actuarial assumptions, whether it's the mortality tables, making sure they're not too far behind on the mortality tables, because that can definitely affect us. Luckily, we're all living a little longer according to the actuarial mortality tables, but as people live longer, that'll increase that liability out for those pensions. Investment rate of returns, the other thing we have to look at is to make sure, hey, does that make sense where it's at? Now, the state on the police and fire pension plans, they have a lot of say into what that investment rate returns. 25 years ago when I started auditing, I can't believe it's been that long, it was easy. We'd see people at 8.5%, 9% assumed rate of returns. Now everyone's, down in the 7s. So those things change over time. And we need to be making sure, and the client needs to be making sure as well, that those are evaluated.
All right, thanks, James. Looking a little bit more too at just some of the general differences in Florida and unique situations that some folks might be looking at an actuary report and saying, so what exactly is this concept? So when we see terminology like frozen state monies or even share plans, Chad, what exactly are some of those concepts that we see, particularly on public safety plans?
So unique to Florida is we have a tax on insurance premiums. 175 is for fire, 185 is for the fire taxes. Are the 175 taxes are applied to like homeowners insurance and property insurance. The police side is tied to insurance on other casualty insurance, such as vehicle insurance and things of that nature. So there's a rate that's applied to that. So what happens in Florida, if you have for public safety, for police and fire, is it's one of these things, we talk about it as though it's state money, but it's actually not. It's the municipality's money. The money is collected from the local taxpayers and then sent to the state. And the state then takes out whatever it needs to fund the state division of retirement or whatever else. And then sends back to the municipalities, if they jump through certain hoops, the remainder of that money. So the hoops you have to jump through are outlined in Chapter 175 for fire and 185 for police. And those are just the requirements to get that money back. One of the differences between police and fire, they have two different rates that are charged, by the way, on the insurance premiums. But one of the rates, the rate that is charged on the fire side, once that money comes in and is sent to the state, now the state looks at it and they, through an annual reporting system, determine what is your annual payroll for the fire department. And then there is a percentage of that, I think it's 6% right now, that you can't initially in your first check receive more than 6% of what your aggregate payroll is. Everything above that is still held by the state. And then they look at the Florida Educational Trust Fund, Firefighter Educational Trust Fund. It's a fund that pays additional money to firefighters that receive higher education. You know, if they get a degree or a master's degree, there's additional pay that's involved, and it is funded through this educational trust fund. So what's happened in recent years, used to, when the Division of Retirement would send that wad of money, the excess above the 6% of pay, or whatever the percentage is, when they would send it to the Educational Trust Fund, which I think is actually run by Department of Revenue, when they would look at it, you would get back, you know, 60% of it or 80% or something like that. And then it started dwindling down to half. Year before last, it was maybe like 5% of it came back. Last year, none of it came back. The reason it didn't, and that's where, when James mentioned earlier, the idea of the second check, the supplemental check, that's what that check is the monies for firefighters above that percent of pay limit. They're able to get that money back. Now we're not seeing that, and it is because the Educational Trust Fund needed more money, and they needed more money than was actually coming in, so that money cut off. And I don't know when in the future we might see those second checks again. They may be gone for good. For you folks as municipalities, one thing to be aware of is that it is tied to the amount of that money that you receive. And the first check is tied to total department payroll. So like as an example, I'm aware of a municipality in South Florida that at some point rolled their lifeguards under the fire department budget, which made them part of the overall payroll, even though they're not included in the pension plan itself. In doing so, that increased that department payroll, which meant they got more of the money in their first check. And one of the things, I mentioned this at the beginning, but to be aware of, it's not the state's money, it's your municipality's money. It comes from your taxpayers. So anything you can do to try to get as much of that as you can is always useful. But we've seen that, and that's one of the things we learned through the implementation of GASB 67, 68, is that we have to treat this as money that is the municipality's money up front. It's a contribution from the municipality, even though it gets circled through the state and then comes back to you.
And I think that's a good point, because one thing I was going to throw back to James, in addition to any other thoughts James might have, is with regard to those insurance premium taxes, they of course show up in the pension plan financial statements, but do you want to quickly touch on the proper recording of those and why, in terms of at the actual local government level?
Yeah, they're considered for accounting purposes under governmental accounting standards to be on behalf payments. So with those, you have two options. You could include them in your general fund as that state insurance premium taxes, and then you increase your contribution expense out to the pension plan, or you could, some people record it strictly in a special revenue fund. Both are allowable. I typically see most people just run them through their general fund, because that's of course typically where your fire department's going to be. So that's usually for the accounting of how those are, but sometimes that gets missed, because really that's a cost that if it wasn't being helped with those state insurance premium taxes, that cash would still be needed to fund the pension plan. So that's why you want to see it as an expenditure in your general fund. And sometimes we have, go ahead.
I'm sorry, I didn't mean to interrupt. I wanted to chime in on that. One of the things I did want to point out, when that money, you know, even though it's treated as being a contribution from the city, ultimately in the accounting exhibits on the pension side, one of the things to be aware of, there have been some places around the state where folks have considered, you know, I said you have to jump through certain hoops to get that money back. Some places have decided they don't want to jump through those hoops. It may be too expensive or whatever else to provide a minimum benefit of a certain level, or a retirement age, you know, at a certain age. If they choose not to do that, then they don't get that money back. What's important about that is you don't get it back. It remains with the state and goes into the state's general revenue. So even though it is from your local taxpayers. If you choose to not jump through those hoops, you don't get the money back. It stays with the state.
Yeah, that's a good point. Even people that just have, smaller governments may have volunteer fire departments. I have some cities where they have a volunteer fire department, and that's the only place those state insurance premium taxes go is into the volunteer side. They have a regular fire department, and in one city, they're not even a defined benefit plan. They're on their normal defined contribution plan. So for them, their whole volunteer fire department is funded through their state insurance premium taxes. And on some small governments where they may only have, like some towns, there may just be the paid fire chief and maybe one other paid firefighters and then a whole bunch of volunteers. A lot of times we see the state insurance premium taxes basically cover the entire amount of what it costs to run that pension system. So it's an interesting little dynamic for some smaller towns.
All right, well, anything else to add on those topics, or should we move on to our first polling question?
I'm good.
All right, so our first polling question, we're going to pop this up in just a moment. Feedback from past webinars have said, it sounds like the fun webinar or fun polling questions as opposed to kind of the quizzes been a little bit more exciting. So given that we do have an hour of listening to auditors and actuaries, we're going to try to keep it a little fun as we get through these polling questions. So I did pop up the first polling question. One quick reminder, if you do have the webinar view in full screen mode, you may not be seeing this polling question right away. You may need to exit full screen mode to answer it. But our first question is, do you look forward to meeting with your actuary? Three choices here: yes, no, or not as much as you look forward to meeting with your auditor. We have just a few more seconds, we'll leave. I still see some answers coming in. We'll give it maybe about another 10 seconds or so for anyone not with getting their answers in yet. One quick reminder, if you do run into any technical difficulties trying to reply to the polling questions, please feel free to submit a question through the GoToWebinar control panel, just saying that you have seen the question, providing an answer that way. As long as we're able to track your attendance through the polling question or something similar, we will still be able to offer CPE credit. So please do that if you are unable to respond to the question. That said, we're going to go ahead and close the polling question, and we will share the results. It looks like we've got a pretty split yes and no group, and then Chad, I guess we've got you beat. 58% say they prefer the auditors.
So I think there's maybe some actuary bias there,
Yes.
So what we'll try to do to help Chad out is we'll try to bring Chad along to some meetings with you guys so you can meet him and understand that he's not as scary as auditors.
All right. So getting into the next step of the looking at everything, we're going to look a little bit at just what starts going into the valuation as we build up to actually having that final actuarial valuation or report. So we've talked about it a little bit already, referring to all the assumptions that go into the report. So Chad, starting with you, I would say, when you start, how do you go about developing all those assumptions, and how does that framework get established as you build up to the actual valuation?
So the assumptions themselves, there's a large array of various assumptions we apply to generate the liabilities that we do. The four main ones, there's four ways to get out of a pension plan, which is to retire, die, become disabled, or just be terminated. We have assumptions for each one of those. We have a rate associated with dying, becoming disabled, et cetera. But in addition to that, there are other smaller assumptions, such as sometimes we need to estimate the percentage of the population that's married to value a joint survivor type benefit. We generally have to make an assumption about the age of a spouse. I will tell you that the standing rule, and I'm willing to bet that 99% of funds in this country still use this, that If the participant is male, the spouse is assumed to be 3 years younger. If the participant is female, the spouse is assumed to be 3 years older. That's been sort of a standing rule for a very long time. We're starting to see some discussion, at least, about revisiting that. In today's world, we don't have clearly defined gender roles always. We don't, things that are reported, especially in your larger plans, you may not have a gender reported at the choice of the participant. So there's various things that we're starting to develop and work through in those examples. But in that situation, for instance, the age of a spouse, some of these are just standing rules that have been around for a long time. The percentage married, for instance, if you were starting a new plan, you would probably pull up percent married assumptions that are used in Social Security and start with those. And then over time, we adjust these assumptions to match up with what's going on in reality. Typically what happens now, most of your pension plans have been around for a very long time. So when a new actuary comes in, they have the assumptions that were already in place. They'll do an experience review, say every 5 years, and get a feel for the disability rates we have in place, expected that over this 5-year period we would have had 2 disabilities, but it turns out we had 10. So we need to move that disability expectation higher and make a small adjustment. That's very common. We do it all across the state. We can't generally use the actual information from each municipality and develop tables. And the reason is because there's just not enough data there for us to have a good confidence in the probabilities that we would generate from that. So typically for most things, for mortality in the state of Florida, we're now required to use what is provided by FRS. But for other assumptions, we tend to use larger population statistics to come up with those various assumptions.
So on those experience studies and looking back at what actually happened, any rules of thumb of how often those should be done or anything to that effect?
Typically, I would say that experience reviews are, in most places, they're performed about every 5 years. But to be honest, if you're a plan that only has 5 employees, I mean, that exists. There's a lot of municipalities in Florida where that may be the case. Then it may not make sense to review it every 5 years. You're not going to have any reasonable numbers to work with. Everything we do relies on what's called the law of large numbers, and we just don't have those large numbers in a smaller plan. Those smaller plans typically will not do experience reviews very often. But for your standard plan, I would say about 5 years is about how often you ought to do an experience review and true up your assumptions.
Hey Chad, with the OPEB just being out a couple years, I don't know if you've seen this, but thinking that before you had your police and fire that were in the defined benefit plan, so you saw experience studies there. Have you seen anybody looking at, hey, is it going to eventually need an experience study potentially for OPEB? Incorporating all that in at once and doing a citywide experience study. Is that anything you guys have talked about in actuarial world?
Not exactly, because on the OPEB side, ignoring the process of actually developing the rate that is paid for the benefit itself. Once you have, in Florida we deal with this implicit subsidy a lot. So once you have determined that you're going to have to deal with this implicit subsidy, it really boils down to when are people going to retire, how many are going to elect to keep that coverage, and then how long are they going to live, or how long are they going to receive that, and does it cut off at Medicare age, et cetera. So typically we're not doing a lot of experience reviews there. And to the extent that you can, you tend to rely on the health insurance company as far as what those rates should be and the growth of those rates going forward.
Thanks, Chad.
And James, looking at the assumptions from the audit side, so what do we do in terms of performing the audit and assessing whether the assumptions are reasonable, or what are the required procedures?
Yeah, for the audit side, we definitely have to look at those assumptions. As I mentioned before, we, of course, compare them to other actuarial reports we received, as well as looking at what the state's using on the FRS side. We'll look at those a little bit so we can kind of get an understanding of where the trends are going. on those. You know, for OPEB, one thing that comes up is because there's usually not a trust fund. We don't have a lot of clients to have a trust fund for OPEB, so you have a rate that's used there. And most actuaries are right around the same number. Every once in a while, we'll see one way out. And then we got to kind of have that awkward conversation with the client to say, we're not sure why this actuary is using 5% on this OPEB where everyone else is around 3.5 for this year. And so we've had some of those, and those are a little bit awkward because, you know, we're not actuaries as auditors, but, you know, we know enough to say that doesn't really make sense what they're trying to say there. And as I talked about before, you know, census data, you know, we do have a requirement to test that. The other thing we test as auditors is benefit payments. You know, when especially, you know, that first year when someone starts receiving benefits, you know, from a plan side, that's the risk, is the right amount being paid to that beneficiary. Is if that retired police or fire or even general employees, we have some that for pension plans. And the risk is never that the employee is getting paid too much, because most of them know exactly. They got the they probably know as well as actuaries do exactly how much they're going to get in their retirement. So our risk from an audit side isn't that they're getting, you know, the risk is they're going to get too much money paid out, and they're not going to tell you if they're getting more than they expected in their retirement benefit paycheck. You know, they'll definitely come to you and back to the city and the pension plan if they think they get paid, if they're getting paid less than they expected. So we have to look at that risk from that side. So we'll usually do some testing of those benefit payments, especially in those first year ones, because once they're kind of set, you know, they usually will continue on either at the same rate, or if there's a COLA in the plan, you know, they may go up by that COLA increase.
All right, and on the investment rate of return side, where that's one of the largest assumptions that drives everything, one thing I know is it was probably 3-4 years ago now where there was a big to-do in terms of what FRS had as their assumed rate of return, as opposed to what was in effect reasonable based on actuarial standards and otherwise. So really for either of you, you know, how do you assess or draw the line in terms of what is a reasonable assumption for that investment return? You know, when we see plans that are in the 6s, plans that are in the 7, even some that might still be at 8%, what factors kind of do you use to say, is this reasonable, or where do you kind of, what would become the spot where you have to draw the line and say, hey, this is just not reasonable?
So I'll start on that. In our world, we rely on capital market forecasts. And so, for instance, right now, those numbers based on your typical plans allocation or whatever, if you look at, like JP Morgan is probably the industry standard when it comes to capital market assumptions, but their outlook is 10 to 15 years when they generate those assumptions. We really, as actuaries, need something that's, you know, 30 years, something in that range. At least in my opinion, that's what we should be using. So, but even with the longer ones, a lot of the capital market assumptions that are generated are based on some sort of reversion to the mean and based on where we are right now. So what's happening right now is we have had such a good market for such a long period of time that if there's any sort of reversion to the mean, then we should expect to see lower returns going forward. Now, that being said, it's my understanding that this year, mid-year, JP Morgan jumped in based on what happened with the pandemic, that they upped their capital market forecasts for most asset categories, or at least I guess on the equity side, by 100 basis points, which is a lot to expect that, you know, suddenly stocks, after what has happened, that going forward, we're going to earn 100 basis points more over a 10 to 15 year period than we would have otherwise. It's a big swing. So that's what they're typically based on. And I will tell you that, you know, based on capital market assumptions right now, with a typical allocation, you're looking at something that is 7 or less than 7 once you add it all up. Then it's the actuary's judgment as to whether that significantly conflicts. So as an example, in our valuations, I will tell you this, that, you know, as an actuary, we'll come in and recommend to a client that, you know, we think their rate ought to be say south of 7%. We say for their allocation that might have come out to be 6.9 or whatever. We deliver that to the board. The board is in charge of the assumptions themselves. They take recommendations for their professionals, but it's up to them to decide what the assumptions are. And so typically they will say, well, we were at 7 3/4, we'll take it down to 7.5, or we'll take a 10 basis point drop, or whatever the case may be. When they do that, and they're that far away from what we believe the long-term number ought to look like, there's a statement that's put in the valuation, and the FRS had it in there. I don't think it's in there this year, but it's a statement that basically from the actuary says the assumed rate of return is an assumed rate as set by a governing body, which is the pension board, and that assumed rate significantly conflicts with our assessment of what is reasonable. And then, so in my case, I would say that the majority of my clients have that line in there, because the board, they also have to consider budgetary constraints and can't make as big a decrease as we would like to see them make as the actuary. So typically, and I believe FRS is now at 7.2. They have been going down on a pretty regular basis. I believe that at the last assumption conference, I can't remember, but I want to say that the actuary for FRS was recommending maybe 6.8, something in that range, but they did get it down to 7.2. So if you're still at 8, you need to really revisit that. You should be talking to your, well, I say you, the board should be talking to their actuary and their investment consultant about the probability of actually getting 8% going forward with almost any allocation.
One thing to mention, Zach, I always think about, we think about all these different assumptions, whether it's the investment rate return is sometimes one of the easiest ones. And I can really tell when I'm talking to a city or city manager if they really understand how that affects things. Because those assumptions will affect dramatically the amount of the required contribution from that city. So the ones that really understand it, they sometimes will be a little more aggressive potentially, because it depends on how the budget is. And this time we're going through right now, there's definitely going to be some budget issues. Is we may see, and you'll probably start feeling a little pushback on some of the assumptions, because they know, hey, if we keep this investment rate of return a little bit higher and not drop it, that's going to help us not have to increase the amount that the city needs to put into the plan, which will help manage their budget overall, make that part a little easier. So my guess is there's going to be a little pressure on the actuarial community, just like it was 10 years ago. Probably you went through it on those assumptions, but that always tells me a little bit about the management of that local government. Is how astute are they to really understand the impact those actuarial studies have back on their budget.
Absolutely. So we've talked about census data a little bit, but let's just jump in a little bit more. James, first from the audit standpoint, we are required to test census data. You want to touch on exactly what is required in the audit environment?
Yeah, I'm actually gonna, one of the things we have as auditors, we all get peer reviewed every 3 years. Any auditor you're using is getting peer reviewed, I hope, every 3 years. So this is straight from the peer review checklist, and one of the things is, was there substantial procedures, that focused on the incremental changes to the census data file? As I mentioned before, we have to have the last census data file and the current census data file, and looking at what those changes were. There are times I know that we've picked up, hey, what happened to this employee? This employee was in last year's file and now they're not here, but they weren't terminated. They're still with the city. A lot of times our actuaries catch that as well. And when we've contacted, either the city's contacted the actuary or we have on behalf of the city, they'll say, yeah, we noticed that too. They're included. So it's just sometimes it's how that data is pulled. We also have to, as I mentioned before, test new hires as well as test inactive members, to make sure that some of their demographic information is correct, especially on the OPEB side. That's where we have to test that side, is saying, what's the age, is it male, female, those type of things, come into effect on that census data. And when you deal with multi-employer plans, we even have responsibilities with a city that's on the state retirement system. We still have a responsibility to look at the information and test that information that's being provided up to the state, and then ultimately that's audited by a separate auditor, and they actually go through a process where not only do they audit the FRS system as a whole, they also audit the FRS system, and the schedules that are in there are audited down to the employer level inside there. So that's why we don't, as auditors, have to say, if we're auditing a county, we don't have to go to the state of Florida retirement system and do additional work. It's because the state of Florida has hired an actuary, hired an auditor for their plan that audits those employer schedules.
All right, and Chad, I assume your procedures when you get the census data pretty similar. Anything notably different, or in addition to, or otherwise?
So as actuaries, we do have standards of practice that govern how we treat data and what we need to do with it to make sure that it is reasonable. We're not required to reconcile it down to the penny, but I will tell you almost every actuary does. It's just the nature of what we do. If you send me a list of participants, and I have the list of participants from last year, I'm going to compare everything from, the sex of the participant to the day they were born on. We compare all that stuff, and then we send a set of questions off to the municipality. Typically, if they are small things, such as a small change in a date of hire, a date of birth, or whatever, we'll keep going forward with the work and then say, for next year, let's see if we can find out the answers on these handful of small questions. But actuarial work it's all a mathematical model. So we want it to be as accurate as possible. But historically, there was a period of time, I think it is still done in certain places, because of the process of actually running liabilities. We used to use what was called celled data, meaning that if you had people between, say, age 20 and 25 with 0 to 5 years of service, that's a cell. And all we would need to do is come up with a salary for that cell. And then you would say there are, 2,500 people in that cell. And we would run the liabilities on that cell as one person, then multiply it by 2,500 people. And that's typically how it was done in the past. Over the years, the software has gotten so much more sophisticated that now we check everything. I'll give you an example. We have clients where you have this accrued leave issue. So sometimes when a member comes up to retirement, the plan may allow for a payout of accrued leave to then apply to their final pay and pension, and then have the contribution taken out of it. So how much are they going to get? Well, in the past, we would have just come up with some sort of average or whatever, but these days we get an actual dump of what the person's accrued leave was at the time it was frozen, because now it's frozen under state law. We get whatever that accrued leave was and actually make a factor to apply to every individual person. So we do get into the data deeper than we are required to. And that's not a me thing. That's actuaries around the state of Florida and actuaries in general. It's just the nature of what we do that we tend to go a little bit farther in on reconciling that data.
Gotcha. So moving on, looking at dates in terms of saying, okay, what's the final report going to be based on? Lots of terminology that gets thrown out there. There's a valuation date, a measurement date, and a reporting date. So probably, Chad, just want to see if you could maybe walk us through those different dates, kind of what they are, how they relate together, or how they're different, because I know that's one that can confuse a lot of people trying to make sense of all these different ERNs that they see on a report.
So these dates are really for the GASB side of things, for the numbers that the actuary is going to produce that are ultimately going to go into the accounting statements. The valuation date is when we're actually taking the snapshot. So the day, typically in Florida, it's September 30th, the day in each year where we're going to take that snapshot and run liabilities. That's the valuation date. The measurement date, for instance, for timing or whatever reason, if you wanted to project it out, the measurement date could be, say a year later. So we're taking the liabilities that we ran on the valuation and moving them forward a year to use them in the following year. The reporting date is when you are actually, is is what is going to be represented actually in the GASB 67, 68, or in the OPEB side. It's what's actually going to be in the report. It's that date. Those 3 dates do not have to be the same. The reporting date has to match up with whatever your actual accounting exhibit is. They have to be the same date.
Yeah, so to make sure kind of we've got it clear, to summarize, kind of the valuation date and the whole valuation process, that is solely for the liability in effect. And then the measurement is when you take that liability at the same date or you roll it forward and apply the assets at that date. So you kind of take the measurement as assets and liabilities, where the valuation is just that liability. From an audit or a financial statement side and kind of preference, James, what are your thoughts in terms of the dates being different, the dates being the same? What makes life the easiest from a finance director's standpoint and from an audit standpoint?
Yeah, well, first I want to say I think actuaries feel like accountants some now. And I know as an auditor and probably some of our governmental accountants, they feel like they have to be actuaries now too, you know. So it's kind of an interesting world. We're each kind of delving into the other person's world a little bit, and we're enough to be dangerous. But on the dates, you know, what we typically see is it kind of depends on the government on how quickly they think after, you know, for each year end, they can get their census data and that information over to their actuary. So if they feel like, hey, we can get them over there quickly, and then most actuaries, you know, work on a, you know, FIFO basis, first in, first out. You know, whoever gets their stuff first is going to get their actuary report out. Then they may wind up using a measurement date of, say, September 30th, 2020, and then the report date, of course, will be September 30th, 2020. So that works well if you know that you're going to be able to consistently do that. And for some people that works, you know, sometimes that turnaround could be 3 months, could be 4 months on the actuary side. I do have a lot of governments that do 1 year behind. And so with that, so their reporting date is still September 30th, 2020, but their measurement date is 1 year prior, being September 30th, you know, 2019. And what that gives them the flexibility to do is, one, they don't need to be in a rush to provide that actuarial data over, but they'll also have that information typically sometime in the summer. They'll have that information from the actuary for the 68 calculations. We'll also typically see if they're 1 year behind, they'll typically do that report as well would be 1 year behind. You know, at that point, you have the information that you can record your net pension liability. You can record your OPEB liability as well. So that's the advantage if you think you're not going to be able to get your stuff in quickly, and you're worried about delaying your financial statements being done. That's the advantage of being a little bit sooner in that rather than later. Or if you have you know, anyone on FRS, we know there's a difference there. FRS is on a June 30th year end for the state retirement system. Most local governments, counties, you know, they're all on September 30th. So for every one of those, there's that difference between your measurement date and your reporting date. So you have to pick up as a deferred contribution amount there. You pick up that deferred outflow for the contributions. You know, just 3 months for an FRS plan. If you're a city and you have a fire plan and you're a year behind, that's going to basically be 1 year worth of contributions that you're picking up. So it's really a matter of preference, you know, for that particular government of what they choose.
All right, and real quickly looking at the actual funding and how that comes into play in terms of the valuation for funding purposes, Chad, when we look at that, really how early can the funding percentage or a dollar amount be set for a future fiscal year, and what's the normal timing on that front?
Typically, it is 1 year in advance. I do have some clients, and I've seen in other places around the state where it's done on the actual year. So as an example, typically we're delivering valuation reports at February meetings for the pension board. So when we're delivering that report in February, are we telling you the contribution that needs to go in before the end of this fiscal year, or the contribution that will begin starting October 1st of the following fiscal year? I think the majority of plans do it where it is the October 1st of the following fiscal year. That way, when you receive your valuation and your audit and they're adopted, say at a February meeting, if you're doing budget hearings or whatever in April, that gives you already know what your number is going to be for the next year. That's typically how it's done, although it does require an increase in that contribution because the valuation date, for instance, will be October of 2019. Since the contribution is not going to go in until October 1st of 2020, or starting then, there is an interest adjustment. Now, I will say that one thing we're seeing more of around the state is when the actuary does that, typically, doing a projected valuation, we'll project it out to October 1st, 2020. We're seeing more municipalities choose to put in the entire contribution October 1st of that year. Granted, for police and fire, there may be some adjustments because you don't actually know what the state money will be for that year until you get to the end of the year. But what that does is that cuts out basically a half year worth of interest between doing the contribution spread throughout the year or doing it all at the beginning of the year. So we're starting to see more of that around the state, just to save a little bit on the interest side.
Yeah, because everyone's getting so much money in their money market or their SBA account. Right now it's probably well worth that as opposed to paying the interest on the pension plan side.
Yeah.
Definitely. All right, well, let's move on to our second polling question. This one a little more standard. Looking at what will your investment return be for fiscal year ending September 30th, 2020, compared to what your plan's assumed rate of return is. Again, just a real quick reminder, if you are unable to view the polling question, if you're in full screen mode, please try exiting and see if that helps you access the polling question. And if you are having any technical difficulties responding to the question, please feel free to submit your response via a question in the question control panel, and we will record that as well to help ensure that you will receive CPE credit for today's session. We have still just a few more responses coming in, it looks like. We'll give it another 5 or 10 seconds. Another 5 seconds, 4, 3, 2, 1, and we'll close the polling question. And to share the responses, it looks like almost 3/4 are expecting it to be lower than the assumed rate of return, and about 1/4 hoping to be right on target.
So we have a lot of pessimists, is what we're saying. Not a lot of optimistic people, only 4%.
Well, of course, it has been. I know there's been a recovery, and Chad, I don't know how recent you've seen any data for plans you work with. I know last I had heard, I think for a couple plans as of March, they were only a couple percent down versus the 15 to 20% drop off I think a lot of plans had seen back in February or so.
So at the May meetings that we typically go to quarterly meetings for all of our clients. And so at the May meetings, the investment consultants were presenting results through March 31st. And those results were not great. However, they typically would look to, a recent day, a few days before the meeting or whatever. And for a lot of those plans that were having meetings in May, as of, the end of April or early May, they were either at or slightly above where they were October 1st of 2019, which again is a negative. If you're flat, that's a negative return because you had contributions that went in. But if you ended up with the same amount of money, at least it's not the huge negative that we had seen earlier in the year. But it's a long way to go to September 30th. September is typically a fairly volatile month. So I don't have any crystal ball on where we're going to end up, but I will tell you that most of the clients that I have seen are close to or in the neighborhood of a zero return so far through this fiscal year.
All right, and looking at the big picture, obviously we'll see what the impact is of the most recent investment downturn and what that does to the unfunded liabilities. But looking back even just a few years now, it's been about 5 years or so since the implementation of GASB 68. And just curious, probably from you first, Chad, because I know we haven't seen too much from the audit side. Have you seen any sort of major impact from the recording of pension liabilities and OPEB liabilities on smaller governments or even larger with regard to bond rating agencies or anything else like that when the financial position impacts have been pretty significant? Have you seen any, tangible ramifications out of that?
We have not yet. Now, that being said, in all fairness, the vast majority of our clients are in Florida. And so if you back up to how the GASB rules were established and what they're there for, the old method, GASB 2527, we measured as we put on the municipalities' books as a liability the difference between what they were told to put in and what they actually put in. The difference between those two was the net pension obligation, and that's what showed up as a liability. The expense was essentially just the contribution you made. In the new world, under both OPEB and current pension GASB statements, the liability is ultimately essentially the unfunded liability, and the expense is sort of the change in unfunded from one year to the next. So they went from having a tiny liability or no liability to this unfunded, whatever that happens to be, which typically is going to be larger than whatever the original NPO was. What then happens is, under the accounting rules, the actuary has to do a run out of when the plan will run out of money based on their past contribution history. And then we discount the liabilities using two numbers. One is, until the plan runs out of money, we use the long-term rate of return assumption that the pension board uses. After that point, we use what is essentially the borrowing rate, because in theory, you would be out of money and you would go borrow money to pay for those benefits. So then we discount it at some 2.5% or whatever the rate is on that 30-year bond, that municipal bond, which is what we would use to determine that rate. So in Florida, we don't have to do that, because the city has always made the contribution because they're required to under state law. There's no run out date where they're going to run out of money. So we don't have this additional liability added in there. The point is that the ratings agencies, when you suddenly start reporting that unfunded liability, if you're in a situation where you have not been making the contribution, that liability is going to be inflated by a bunch because of having to discount with that borrowing rate. So what that does is, it, in theory, is supposed to show who is a credit risk. So it'll affect the bond rating. So if you look at, around the country, state of Illinois or New Jersey, there's a lot of, it's the same names that we keep saying over and over again, where they don't put in the required contribution every year. They will have a really large liability under the new GASB statements. And that will cause the rating agency, in theory, to look at it and say, all right, well, maybe they're a credit risk. And arguably, that's how it should be, because remember, the plan, which we talked about in the beginning, is defined. Here's what we want to pay our participants. So this is a promise we've made. And then the pension board says, all right, here's how much money you need to put in to pay for that promise. If they're not putting that in, they've made a promise that they're not going to pay for. And that should show up as a bad credit risk. In the state of Florida, we just haven't seen that problem at all. Even with this new liability being added in, all of our municipalities are not bad credit risk, because they make the contribution every year as required by state law.
All right, anything that you have seen, James, or any impacts from the audit side or otherwise?
Yeah, I think there was a slight impact, primarily enterprise funds, or if there's entities that are just business type activities where they had significant bond covenants or debt covenants. As you threw in the GASB 68 and then threw in 75 for OPEB, those all hit operating expenses. So if you had any ratios that, depending on that operating income, some agencies had some issues there, but usually not too much. One thing that was interesting was, before, when 68 first came out, the Auditor General, there's part of our process on financial condition assessment as auditors, is we're required to look at if total general fund unassigned fund balance is at a deficit, if total proprietary fund net position is at a deficit, and previously we were also required to look at that as well government-wide. Well, the Auditor General quickly realized when 68 was coming out, in most cities, when you threw that 68 liability on there for net pension liability, it was going to flip that government-wide unrestricted net position from being positive to being negative. So they quickly changed that part of the financial condition part where we're required to look at that, because they realized, because what happens is that would trigger a comment in the AG letter that would say, hey, this government had an unrestricted deficit in the government-wide, which we all know what that means. If it's in the Auditor General letter, it's going to be in there 2 years, because there's no way you're going to fund it enough to get rid of that deficit in your unrestricted net position, which meant there's going to be 2 years in there, which then meant it goes to the Joint Legislative Committee at the state of Florida. They send a little letter back to the local government saying, hey, you have this comment, it hasn't been resolved in 2 years, what are you doing about it? So luckily the Auditor General realized that early on and rectified that to at least exclude it out of the government-wide financial statement for what we have to look at. So that was one effect. We did have some smaller governments, some small towns and cities that when OPEB came out, they said, we're not going to do it. We're not going to spend the money to have an actual analysis done. And so they basically, right now, we have what's considered modified opinions on those small towns, where basically say everything's, presents fairly in all material specs, except for there is no presentation of OPEB liability. So we did have some governments go that route, where they didn't want to take the expense to do that, and there's been no issues with those with the Auditor General. So that's just, two of the things I know, that we noticed for that. And of course, it increased costs. The OPEB increased costs, 68 increased costs for both the pension plans and the cities on both sides. So it just increased time internally for those individuals having to do the accounting for that.
Yeah, I think it is worth noting too that while we just observe what we see and how the rules are interpreted by the state, we have seen that for any qualified opinions related to not having an OPEB valuation performed, the state, I've never seen them come back. But I know that we did see a couple situations where there was a qualified opinion for GASB 68 not being followed. I believe the state does follow up on that. So from the state standpoint, they're generally okay with no OPEB, but not in agreement with that not being present on the pension side. Real quickly, because I know we do have some COVID-related items to talk about. 30 seconds, either of you want to touch on anything that you're seeing in terms of trends with regard to funded percentages and otherwise of plans?
I'll just say that we have seen them improving, over the last decade or so, due in part to better returns in the market, but also because of after the downturn in 08, 09, municipal contributions went up so much that we're receiving additional funding. So we are seeing those the funded percentages improve. That being said, we'll see what happens at the end of this year.
Yeah, I know as an auditor, I get asked a lot. The question is, well, they see that funding percentage because they're required to report it in the required supplementary information, and it says, 86% or 76%, and they all want to have a scorecard. And then I say, okay, I'm not an actuary, but it depends. It depends on the makeup of your pension plan. How what's the population of your current members? Are they close to retirement? Are they far away from retirement? All those different things factored in, but they all want like this magic letter grade, and I got to tell them that you can't compare one city's pension plan to another's on the funding percentage because the demographics and other factors are not going to be equal. So there's just something for people to think about there is, as Chad's mentioned multiple times, in Florida, you have to put your required contribution in. And as long as you're meeting that requirement, you have sound actuarial assumptions, the plans in Florida are going to do well.
All right, well, let's move on to our third and final polling question. As promised, we said we try to have a little bit of fun. So to wrap up the polling questions, we have a scenario for everyone. And the scenario is an actuary and an auditor walk into a bar. You now need to tell us what happens. Does someone say Norm? James told me that was a Cheers reference. Are there free drinks for everyone in the bar? or in the COVID-19 era with an actuary and an auditor, there is social distancing inherently not going to be an issue. Looks like about 2/3 have responded so far. We'll give you all a couple more minutes. Just a reminder again, if you are having any trouble submitting questions or submitting a response to the polling question, please feel free to send us a note through the questions pane on the GoToWebinar control panel. Looks like just about everybody has responded. We'll give it another 5 seconds or so, and we will check out the answers in 3, 2, 1.
Yeah, and I'm really sorry, Zach, that you didn't get the Cheers reference,
All right, so the almost majority says that social distancing is not going to be an issue.
Yeah, I would agree with that. I don't know how it is in the auditing world, but there's a standing joke in the actuary world that the difference between a coconut and an actuary is you can get a drink out of a coconut. So I know the free drinks thing doesn't apply.
Yeah, well, I've always got my own actuary joke where, some people will, so I look at the audit is fun and exciting, and actuaries, I'm like, I don't know how you guys do it. And so when people tell us, that how do we do, live in an audit world and just only audit and be stuck in the numbers and all that. And we always tell people is, well, if you think we like numbers, go talk to an actuary because they really like numbers. So, all right. So a couple last few questions as we look kind of towards the future, some changes, what's to come. I know there's a few changes in terms of risk measures and otherwise that have to be disclosed. So Chad, do you want to touch briefly on some of those changes coming up?
So very quickly, these are going to be in all your actuarial evaluations going forward. They started last year, but we're doing risk measures that are more like enterprise risk. We're looking at the bigger picture. So I'll just give you an example of one of the things you might see is a comparison of the assets over time to the net cash flows. So as an example, as a plan matures, you may end up getting into a net cash flow situation where you're paying out more than you're bringing in. And so a risk exhibit would show you, one of the risk exhibits would show you that you've reached that point. And that's not a bad thing because that's the whole point of these plans is that we always, as actuaries, we always say that, 60% or 70% of the benefits that are paid are funded by investment return, not by contributions. Well, if that's going to be true, eventually you have to be sending out more than you're bringing in. And a lot of plans as they're maturing are finally getting to that point. And these risk exhibits are going to help show, what is that negative cash flow? And then in addition to that, that negative cash flow, what is it as a proportion to our overall assets to see if we're going to have any additional risks associated with, that being a large negative cash flow if the case.
Hey, Zach, we can't hear you.
Sorry about that. I was muted responding to a few questions. Looking ahead to the COVID-19 era that we're about to enter, what are some of the funding issues to be prepared for, and just what other challenges, Chad or James, do you guys see in terms of getting those valuations done and the ongoing funding of these plans?
I think as we kind of talked throughout, I think there's going to be a lot of budget pressure. We're all kind of in the budget season now. Everyone's starting to work on those budgets, and so there's definitely going to be some pressures there. But that's also going to depend on what happens on employees, or cities. Some cities may be looking to lay off people or decrease their workforce. So that's going to affect it as well. And then one thing is on wages. Making sure that the right buckets of wages are included in your pensionable wages. I know Chad and I talked about before about hazard pay and whether that's includable or not includable and little things like that.
Yeah, and on the liability side, you want to make sure that if there are any temporary fluctuations, either in the hours that people are working or in the pay that they receive, be it hazard pay or whatever, if they're considered an essential worker and have to come in, and are you paying them something extra for that, to make sure that you understand and that your actuary understands whether or not that is a pensionable pay. And then when it's reported to the actuary to do the valuation, if there are things that are temporary, say for instance, if, you know, at this point we're dealing with a potential for extra pay or overtime that may only be related to this pandemic, in the next couple of years, as the budgetary pressures come in. I had a municipality that after 0809 ended up doing furloughs, but they were temporary, and you know, we need to know that. We don't need to sort of bake into the numbers some sort of reduction in pay that's only going to be a temporary reduction in pay.
Hey, Zach, I know Chad had some items kind of on COVID type stuff. If you want me to bring those up, I can.
Yeah, we've got just a couple minutes. If you want to do that real quick and switch over to that, we can bring up those exhibits and take a quick look through.
All right, Chad, take it over.
Yeah, so just to let you guys know, as an actuary, the stuff we do, I mean, my wife doesn't want to hear about what I do, and she loves me. So, you know, when I get this opportunity to talk about something that maybe somebody might be interested in what we do, I have to take advantage of it. So there's a couple of exhibits here that I wanted to just touch base with you that at least as an actuary, I find interesting. I think you might find interesting too. The first study that's up there, these are results through like mid-May of all the COVID-19 information that's available, you know, mostly through China. There's a lot of Italy in here as well. But these are, just so that you're not too alarmed, these are the death rates for those that were put into critical care through that point in May. So we're trying to get a feel for, you know, the probability of actually, if you get this virus, first the probability of getting the virus, then the probability of what your mortality rate might be once you receive it. And so the column on the far right represents folks that have pneumonia this was between 2017 and 2019, your run-of-the-mill pneumonia. If they were put in critical care, what percentage of them died? So you can see the column there that shows, you know, if they were between age 16 and 39, they died at a rate of 8.5%. The column in the middle is the same thing, but only for COVID-19. So if you ended up in critical care with this disease, what percentage died? And so you can see as you get into the upper ages there, you know, 65% if you're over 70. And when you compare that to your typical pneumonia, these numbers are about twice that. So if you end up in critical care, your death rate is twice what it would be under a standard pneumonia. And actually, if you'll scroll down a little bit, oh no, I can see it on there as the body mass index. I wanted to touch on that briefly. You can also see that that's about double for body mass index of less than 25. It's about double, and the same is true until you get to that above 40, which is a really high body mass index. You can see that the mortality rate is about triple what it would be for another one. And we talk about all the pre-existing conditions, and you know, there's other things in this. This is a report put out by Milliman. For those of you that are interested, you can find it on their website. But there are all the things with pre-existing conditions, whether it's hypertension, diabetes, et cetera. Body mass index in this country, at least, is an indicator of whether or not you have hypertension or whether or not you have heart conditions or whatever. Yeah. Typically, our body mass index leads to all those other things. If you can flip over to the other exhibit real quick, the question then becomes, this is all the probability of dying once you get into critical care. What's the likelihood you're going to end up in critical care if you catch it? The one thing we can't figure out right now is this probability right here specifically, because we don't know who all has the or has had this illness that didn't end up in critical care, because a lot of people are getting it or asymptomatic or whatever the case may be. We just don't have those probabilities. But when you look at this chart here on the bottom, you can see of those that ended up in critical care, what proportion of them fall under various body mass indexes. And when you see this, you can see that the higher body mass, there are more people, have been more people in critical care with a higher body mass index than people with a lower body mass index. Now that may have something to do with just general population. You know, how many people in the United States actually have a BMI less than 18.5 or whatever the number is that's shown there. So that may have something to do with it. These stats also are coming from, as I mentioned, Italy has a lot to do with this. Italy is not an overly skinny country in general. So they may have just a general population overall that has a higher body mass index. But I found it interesting that we are seeing that. I mean, you saw on the other page, if you end up in critical care, you know, your death rate's about a 50-50 shot, almost regardless of what your situation is. But for those that are, the probability of actually getting there, it does look to me like having the higher BMI does lend to a higher probability you would end up in critical care anyway. So I just wanted to throw those out there. It's not often actuaries get to talk about this stuff and people want to hear it.
Yeah, as I said, we like numbers, but actuaries really like numbers.
Yeah, well, it actually kind of proves the last polling question. If we all want to be safe, we should all go to a bar with an auditor or an actuary.
That's right.
We proved that hypothesis. You know.
So I'll throw one more thing out there. This lady goes to see her doctor, and the doctor says, "I got some bad news." She says, "What is it?" He says, "You're dying." And she says, "Oh my goodness, what can I do?" And the doctor says, "Well, maybe you should marry an actuary." And she said, the patient says, "Why? Will that help me live longer?" And the doctor says, "No, but it'll seem longer."
All right. Well, with that, we are a couple minutes over. I know we've got another slide or two on the PowerPoint if you want to switch back over there, James. But so we do thank you all for joining us today. Our next webinar will, of course, be next week as we continue this series throughout the summer, almost to the midway point. Next week, it's actually my turn talking about budgeting in a COVID-19 world. Just got the content for that presentation pulled together the last couple of days. Should be a good time with some pretty good content, I think. As we look forward to the future as well, we've got a slide in our presentation with contact information for both James and Chad, should any of you have any follow-up questions or otherwise. And then also in the presentation on the very last slide, which you were able to download under the handouts section in the control panel, you can download this presentation. We do also have a link on the final slide to the CPE evaluation link. I also did copy that link into the chat box on the GoToWebinar slide. So please do go submit those requests within 1 week if you would like to get CPE credit. With that, we will see many of you next week. Thank you for joining us. Thank you, James, and a big thank you as well to you, Chad, for joining and bringing your expertise. I know I personally learned a number of things myself, so it was great having you.
Thank you for having me.
Yep. Thank you, Chad.
All right. Thank you all and have a great day.